that our gross earnings grew by 75%, but that is actually comparing the 8-month numbers to the 12-month numbers. So on an annualized basis, we actually grew by about 17% or so in terms of gross earnings. Yes, that was partly contributed to by the loan growth that was significant, but loan growth actually was not the main contributor because, as you know, interest rates were very low last year. So actually it was more our non-interest income that grew by, I believe, about 56% between 2009 and 2010 on an annualized basis. And that was driven by our investment banking business, our ability to structure quite a few deals and earn the consequent fees on those. And of course, that structuring capability and product innovation also allowed the loan growth to be so significant, which is why we saw 38% loan growth.
Right. And deposits also were up 26%. Give us some insight into that, and more so the mix of your deposits right now between low-cost deposits and, of course, term deposits.
Sure, thank you. As a policy, we try and maintain a very healthy mix between low-cost deposits and term deposits, typically in the region of about 50-50, because, of course, we want to make sure that we have stability in our funding base. And we also tend to bank institutions, corporates, and the slightly more affluent individual. So you tend to see that there's a healthy mix of fixed deposits in our deposit base. The successful growth that we achieved in deposits in 2010 was really driven by our strategy of customer intimacy, getting closer to our customers and increasing our wallet share of all our customers. There were certainly new customers that were brought on, but I think the key determinant was, or the key driver, was really our ability to grow our wallet share by increasing customer intimacy, which was really around our sales process and increasing our sales force to ensure that we had more people selling to customers so no customer got left out.
Your cost-to-income ratio at 77.6%, analysts are saying is relatively high, but given the fact that we saw moderate growth in costs in 2010, some are still applauding that performance. But what are your targets for cost-to-income in 2011?
Thank you. First of all, let me comment on the cost containment strategy. We were able to keep costs very flat last year. I think our costs grew by just 3% compared to, I think, most of the industry that grew sort of double digits percentage cost growth. Our cost-to-income ratio was relatively high because our retail banking business is still in the process of break-even. As you're aware, we're a fairly young retail bank. We've been in the wholesale banking space for almost 30 years now, but in retail banking for only the last 4 or 5 years. And in that time frame, we've opened over 100 full-service branches, so they're in the process of breaking even. The existing wholesale business, as well as our micro-lending business, currently operate at a cost-to-income ratio significantly below 50%. The retail business, we expect to break even in 2011, this year. So what we expect in 2011 is a cost-to-income ratio that will be in the 60s as we head towards our long-term equilibrium, which will be sub 50% 3-4 years down the line.
Now, one thing that analysts continue to point at for FCMB is the ROE. Somewhere around 6% at the moment, relatively low. Again, that's what they're saying. What's your target on that front?
Sure. First of all, commenting on the ROE itself, the current ROE, relatively low in the sense that it is directly or inversely correlated to the fact that we have a very comfortable and heavy capital cushion. So our capital adequacy ratio is currently the highest in the industry, above 30%. So naturally the ROE would be low. But of course also we're in recovery mode right now, having had fairly challenging years as the entire industry experienced in 2008 and 2009. And so we were actually one of the few banks that was able to record a profit in 2009, and that has since grown in 2010, as we've seen, with over 800% growth in our profits in 2010, coming from a very low base. We expect that the growth rate, of course, will slow in 2011 and 2012, but we expect by 2012 we should be back up above 20% return on equity while still maintaining industry-leading capital adequacy ratio.
You just spoke of the capital cushion, and 234 billion shareholders' funds. Many are saying that's a lot. and obviously puts you in a very good position to do some M&A transactions. FCMB has been in the news recently, obviously, with regards to M&A. Is FCMB still in the hunt for a rescued bank?
Well, what I would say is that clearly core to our strategy is both organic and inorganic growth. So M&A opportunities will always be looked at very closely by us. We do have significant experience having successfully acquired 3 banks in the past, in the last round of consolidation. We also have this capital cushion that you have talked about that make us able to acquire more banks without requiring or needing to raise additional capital. So it is true that we are very well positioned for M&A. It's also true that we have the experience in terms of the personnel to execute these transactions, and we will continue to look. As to whether we're in the hunt right now for any rescued bank specifically or not, I'm really not at liberty to discuss things that are obviously very sensitive to our share price.